Have you ever been in that spot, where your business has delivered the service, the product's out there, the customer has it, and they owe you money? But gosh, you need cash right now. Maybe to pay your own bills or to grow or just, keep things running smoothly. That gap, that time between sending the invoice and actually seeing the money can feel like a real financial black hole sometimes. Those outstanding invoices, that's your accounts receivable. It's basically money owed to your business. And today, we're really going to dive deep into how businesses strategically use those accounts receivable, how they leverage them to unlock immediate cash flow. Our mission here is to unpack the different ways companies do this. Some methods are common, others are a bit more nuanced. We want to help you quickly grasp these financial strategies and understand why a business might pick one over another. But before we really jump in, just a quick reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we'll discuss, they're derived from the comprehensive accounting resources over at farhatlectures.com.
So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, do check out the website. They've got additional practice questions, video lectures, and really detailed support to help reinforce what we talk about today. Huge thanks to Professor Farhat for providing this valuable material. Okay, let's unpack this. What's the core problem here? Why do businesses even need to tap into these future payments early?
Well, it really boils down to managing immediate cash flow. That's the heart of it. Businesses often have, a lot of capital just sitting there locked up in unpaid customer invoices. Money that might not actually hit their bank account for 30, 60, maybe even 90 days.
It's a long time to wait.
Exactly. And accounts receivable financing is basically a strategic way to bridge that gap. It lets a company get their hands on those funds without the wait. So instead of letting those receivables just sit there, kind of idle on the balance sheet, the company can convert them into cash they can use now.
For operations, payroll.
Right. Paying suppliers, covering payroll, maybe even funding new projects or growth. It's really about making your future money work for you today.
That makes a lot of sense. Okay, so let's say a business needs a general boost in cash, and they want to use their receivables as security. How does pledging work? Is it like putting up all your outstanding invoices as collateral for a loan?
Precisely. That's a good way to think about it. Pledging accounts receivable means you're using your outstanding customer invoices, sort of as a group, as collateral to secure a loan. But the key thing here, the big differentiator, is that the company keeps full ownership and control over those receivables.
Ah, okay. So they're not selling them.
No, not at all. They're just offering them up as a guarantee, basically. And because they still own them, the accounts receivable stay right there on the company's balance sheet. The company is still responsible for collecting the money from their customers.
Okay.
But, and this is crucial for the lender, if the company that borrowed the money defaults on the loan, well, then the lender has the legal right to step in and collect directly from those customers whose invoices were pledged.
Ooh.
Yeah. And naturally, this whole arrangement, it absolutely must be clearly disclosed in the notes to the financial statements. Transparency is key. It's a pretty common choice for businesses that need short-term cash, especially if they have decent credit and, relatively predictable cash flow. It often costs less than some other methods, too.
That's very clear.
Yeah.
This is an example. Imagine ABC Corp. They've got $200,000 in receivables. They pledge these to get a $150,000 short-term loan. What happens, practically speaking, if ABC Corp hits a rough patch and just can't repay that loan?
Right. So for ABC Corp, that $200,000 in receivables, it stays on their balance sheet. And the $150,000 loan shows up as a liability. Plus, they have to put a note in their financials explaining the pledge. But if they default, the bank that made the loan, they now have the right to bypass ABC Corp entirely.
And go straight to the customer.
Straight to ABC Corp's customers. They can start collecting payments directly from those outstanding invoices until they get back their $150,000, plus any interest owed. So ABC Corp essentially put their customers' future payments on the line when they took out that loan.
Okay, so pledging uses the whole pool of receivables as general security. But what if a company doesn't need that broad approach? Maybe they just need to leverage a couple of specific big invoices, perhaps for a particular project or a sudden large expense. That sounds more like assigning. It feels similar, but I guess it's quite distinct.
You've nailed it. Assigning accounts receivable is definitely a more targeted approach, much more specific. Instead of that general pool, you identify specific invoices, maybe one or two large ones, and you formally assign those particular invoices to a lender. Now, usually the company still technically owns the invoices, legally speaking, but the lender typically gets the right to collect the money directly from those specific customers you assign.
Ah, okay. Direct collection by the lender.
Yes. And this method almost always comes with an explicit fee or a finance charge. It's often calculated as a percentage of the value of the assigned receivables, maybe 1.5%, maybe up to 3%, somewhere in that range. From an accounting perspective, that fee gets booked as an interest expense. It's basically the cost of getting that cash early.
Right. The price you pay for speed.
Exactly. And just like pledging, you absolutely need clear disclosure in the financial statements detailing which receivables were assigned and the terms. This can be really useful for businesses, say, with a few very large clients. They can leverage those specific big contracts without having to tie up all their accounts receivable.
Let's make that concrete. Say XYZ Ltd. assigned $50,000 worth of specific invoices to a finance company. Let's call them Finance Co. Finance Co. gives them $48,000 right away, keeping a $2,000 fee. How does that $2,000 show up on XYZ's books? And what's the overall picture for them?
Okay, so for XYZ Ltd., that $2,000 difference, that's recorded straight up as an interest expense. It's the cost of getting that $48,000 up front. The full $50,000 in assigned receivables usually stays on their balance sheet technically, but there'll be a clear note explaining the assignment arrangement. And then Finance Co. takes over. They're the ones who will collect the full $50,000 directly from XYZ Ltd. Specified customers. So bottom line for XYZ, they get immediate cash for a specific need, they pay a clear cost for it, and Finance Co. handles collecting those specific debts.
Okay, so we've got pledging, using all your receivables as general collateral, stays on your books, and assigning targeting specific invoices, direct collection possible, clear fee involved. But like you said, these feel like just two pieces of a much bigger puzzle, right? What are some of the other main ways businesses are using their AR to get cash?
Absolutely. Pledging and assigning are important, but understanding the other methods, like factoring and invoice discounting, is crucial. It really rounds out the picture. Knowing the differences helps companies pick the right tool for their specific situation. And of course, it's vital for getting the accounting right. Each method has pretty distinct features and, importantly, very different impacts on the financial statements.
Let's break those down then. What about factoring? That sounds like actually selling the receivables.
Exactly. Factoring is different because it involves actually selling your accounts receivable to a third party, which is called the factor. And there are two main flavors here. First, there's factoring with recourse. Here, you sell the AR. And a big difference, it comes off your balance sheet.
Okay, that's significant.
It is. However, with recourse means you, the seller, keep the risk if the customer ultimately doesn't pay. So let's say you sell $100,000 of AR to a factor. If that customer defaults later on, the factor can come back to you. You're still on the hook.
So you get the cash, AR's off the books, but there's this lingering risk.
Precisely. You'd likely need to recognize a potential liability on your books related to that risk of non-payment. So it gives you cash fast, cleans up the balance sheet a bit, but that retained risk is the trade-off. Then the other type is factoring without recourse. This is a much cleaner break. You sell the AR, it comes off your balance sheet, and this is the key. You completely transfer all the risk of non-payment to the factor.
All of it.
All of it. If the customer doesn't pay, that's the factor's problem, not yours. You record it as a sale, and you have zero further obligation. It's done.
Wow, okay. That sounds appealing, especially if you have maybe less reliable customers.
Definitely. It offers real peace of mind, especially for businesses dealing with, say, higher risk customers, or maybe they just don't have the resources for robust collections. You offload the bad debt risk entirely. Now, it might look a bit more expensive up front. The factor charges more because they're taking on all that risk, but it frees up the business completely to focus on what they do best, not chasing payments.
That distinction is huge. Let's use an example for the without recourse kind. Brightco needs cash fast. They have $120,000 in receivables. They decide to sell them outright to Quick Cash Factoring for $115,000 using factoring without recourse. What's the immediate impact for Brightco beyond just getting the $115 K?
Okay, so Brightco gets the $115,000 cash immediately. That's step one. Step two, Quick Cash Factoring now owns those receivables and takes on all the responsibility and all the risk for collecting that $120,000 from Brightco's customers. Step three, for Brightco's books, that $120,000 in accounts receivable, it's gone, completely removed from their balance sheet.
Wiped clean.
Wiped clean. And that $5,000 difference, the $120K face value minus the $115K cash they got, that's recorded as a loss on sale of receivables, or often just called a factoring expense or fee. So for Brightco, it's quick cash, the collection hassle is gone, and crucially, the risk of bad debt is totally offloaded.
Got it. And there was one more method you mentioned, invoice discounting. How does that fit in?
Right, invoice discounting. This one circles back a bit. It's actually quite similar in structure to pledging, fundamentally. You're borrowing funds against your invoices, using them as collateral. But crucially, you are not selling them.
Okay, so AR stays on the books again.
Exactly. The accounts receivable remains on your balance sheet, just like with pledging, and you record a corresponding loan liability for the funds you received. A key difference often, compared to, say, a signing, is that you, the business, typically continue to manage the collections process yourself. You collect from your customers as normal.
And then use that cash to pay back the loan.
Precisely. You collect the cash from your customers, and then you use those funds to repay the loan you took out against those invoices. So maybe you borrow against $80,000 of AR, collect it over the next 60 days, and then repay the finance company. It's often a choice for businesses with strong credit profiles who really want to maintain full control over their customer relationships. They don't want a third party contacting their clients, but still need access to short-term working capital.
This is fascinating. It's clearly not just about finding a way to get cash, but finding the right way based on your needs, your risk tolerance, how you want your books to look. Which brings up a really important point. This isn't just, academic definitions. Why is truly mastering these differences so critical? Especially, say, for someone building a career in finance or maybe studying for their CPA. What's the real-world punchline here?
Oh, it's absolutely essential, and for several really profound reasons. Firstly, it's all about liquidity management. These methods aren't just theoretical concepts, they are active, dynamic tools. Understanding them deeply allows professionals to analyze and really optimize a company's working capital. Knowing when to use which tool can honestly be the difference between a business thriving or just struggling to keep its head above water, especially when things are moving fast, like rapid growth or, unexpected downturns.
Making the right call on cash flow.
Exactly. Secondly, and this is huge from an accounting standpoint, disclosure requirements are non-negotiable. If you misclassify or improperly account for these transactions, well, you can seriously mislead anyone reading the financial statements, investors, lenders, even internal management. You might hide significant risks or just paint a completely inaccurate picture of the company's actual performance. Getting the recognition, the measurement, and the disclosure spot on is just fundamental for maintaining financial integrity and building trust.
So getting it wrong has serious consequences.
Very serious. And finally, it ties directly into financial analysis. How a company finances its receivables profoundly impacts key financial metrics. Think liquidity ratios, debt ratios, even profitability measures. Professionals need to be able to look at a company using, say, factoring without recourse and understand how that impacts the debt-to-equity ratio compared to if they were just pledging receivables. You need to interpret these metrics accurately to gauge the company's true financial health and make informed decisions or recommendations. Think about a fast-growing tech startup. Factoring without recourse might seem expensive based on the fee alone, but a sharp analyst understands that the immediate cash injection and the complete removal of collection burden might be exactly what that company needs to seize a market opportunity, making the expensive option actually the most strategic one.
That's a great point. The cost isn't just the fee. It's about the overall strategic fit.
Okay, so let's do a quick flyover recap. We've seen how accounts receivable can be this powerful lever for cash. We started with pledging. AR is collateral for a loan, but it stays firmly on your books and you still collect. Then assigning, targeting specific invoices. Lender might collect directly. There's usually a clear fee and it's noted, but AR often stays on books. Then we hit factoring. This is a true sale of AR. It comes off your books. With recourse means you keep the risk if customers don't pay. Without recourse means you transfer all that risk away, clean break. And finally, invoice discounting, borrowing against your AR, keeping it on your books, like pledging, collecting yourself, and then repaying the loan.
That's a perfect summary. These aren't just entries in an accounting textbook. They are genuinely valuable strategic options for companies navigating their liquidity needs. And really understanding the nuances, the accounting impact, the risk transfer, the control elements is absolutely critical knowledge for anyone working in or analyzing finance. It enables better recording, sharper analysis, and ultimately much more impactful business decisions.
So here's a final thought for you, the listener. The next time you hear about a company needing a quick cash infusion, or maybe you're looking at a company's financial statements and see a footnote about accounts receivable financing. Pause for a second. Ask yourself, okay, what are they actually doing here? Are they pledging, assigning, factoring with or without recourse, or is it invoice discounting? How does that specific choice shape their financial picture? What does it signal about their risk appetite, their customer relationships, maybe even their growth ambitions? What does it tell you about their underlying financial strategy? The answer, as we've seen, might be a lot more complex and frankly a lot more fascinating than you initially thought. definitely encourage you to look at company reports or business news with this slightly different lens now. And remember, for more detailed support, practice questions, and deeper dives on this, you can always visit Farhat